The important thing to note is where you invest is often as important as what you invest in. And the best way to grow your investments is by reducing how much is taken out of it by taxes, by fees, by inflation. Hello everyone, my name is Modupe, and today we'll be talking about one of the most powerful investment tools in the UK, your stocks and shares ISA. A quick reminder before we start, everything we cover is for education only. It should not be taken as financial advice. If you do need personal financial advice, please reach out to a licensed professional. So the important thing to note is where you invest is often as important as what you invest in. If two people invest in the S&P 500, but one of them uses a stocks and shares ISA and the other doesn't, the person that uses the stocks and shares ISA is going to earn more than the person that doesn't. It's just a given, despite the fact that they both bought the same investment. With the stocks and shares ISA, your investments can grow tax-free. So every year, everyone resident in the UK has an allowance of £20,000 that they can invest across cash ISA, stocks and shares ISA, lifetime ISA, or innovative investment ISAs. Now, you have other types of ISAs called junior ISAs, but the junior ISA doesn't take out of your £20,000 allowance. So there's a separate allowance for junior ISA. Now, you can't carry the allowance from year to year, but you can carry the invested sum from year to year. So if you lose your 20k last year, you start this year fresh with a new allowance of 20k. If you only invested maybe £500 last year and there's £19,500 that you could have invested in your stocks and shares ISA, sorry, it's gone. Once the new year rolls in, you start fresh with a £20,000 allowance. The cool thing is once you open an ISA once and you put the money in, that allowance is tied to that year. So for instance, let's assume you open a stocks and shares ISA in last tax year and you deposited £20,000 in there. And then this year, you add another £20,000. The whole £40,000 is going to be tax-free. The one you put in last tax year and the one you put in this tax year is all tax-free. Let's assume you received a bonus, say in January. So you got £40,000 in January. You can actually treat it like 2 tax years because you invest up to £20,000 before April 6th, so anytime up to April 5th, and then invest the additional £20,000 after April 6th. Effectively, you've invested £40,000 in H1 of that year without going against the ISA rules. So every year you keep adding to that bundle of funds that you can invest over decades. And no withholding tax, no dividend tax, no capital gains tax. It just continues to grow. But you don't need £20,000 to start with. If it's only £500 you want to invest the £500. If it's only £1,000, it's fine. Start. The important thing is you set aside an amount of money every month that goes into that. But before you can invest, you need to select a platform where you can open that kind of ISA account. It's not every financial institution that has ISAs. Some banks don't. And even when your bank offers you an ISA, some charge fees for it. Remember what we said, the best way to grow your investments is by reducing how much is taken out of it by taxes, by fees, by inflation. There are a few things I look out for when I'm trying to decide where to open an ISA account. The first thing I look out for here is the reliability of the provider. When I started investing with InvestEngine, they were relatively new, but I could check from their website, I could confirm that they were registered and regulated by the FCA, the Financial Conduct Authority. Then 2, I could also confirm that the assets were protected by the FSCS. Now, FSCS would protect the cash that you keep with them, not necessarily the investment, because investment values can go up and down, but there are other protections for invested money. But the important thing is they're regulated by the authorities. That was the first thing I looked out for. So not every new ISA provider or every new investment app out there would pass this rule. The other thing, which for me is a very important one, because most of the popular providers would be regulated by the FCA, but a lot of them also have fees. A particular provider that I got their details from my employer. They were very helpful. They provided a lot of helpful information, but I never used them because their fees were just too much for me. Too much not because they were high, but too much because in my view they were unnecessary. Considering what is available out there, there are some big name brands, financial institutions that everybody is drawn to because they're the ones you hear about all the time. They're the big investment companies. Some of them handle pensions, some of them handle investments and so on. But when you go into the nitty-gritty and you check, you find all sorts of things, like some of them charging you every time you deposit money into your own investment account. They charge you a fee. Some of them charge you a fee when you withdraw money. Some of them charge you a fee for every trade that you make. So every time you invest, they charge you something. Some charge annual fees that are just standing annual fees for just being with them. While this might have been the norm maybe 10 years ago, today there's so many other ways for these institutions to make money that it's unnecessary. So no, that's the second thing I look out for. You're a regulated company, but the fees must be reasonable. If I use those two criteria, it streamlines my options very quickly for me. And then the third thing I look out for is what's the product range that they actually have. So if I'm trying to invest in the stocks and shares I said, do they have the ETFs that I'm interested in? If I'm looking for dividend stocks, do they have the individual stocks that I'm interested in? The good thing about ISAs now is the rules have been made a bit more flexible. In the past, once you select a provider, you have to stick with that provider throughout the year. But now you can actually split your investments in multiple stocks and shares ISA providers. So, for instance, you could start off the year, put £10,000 with one provider and £10,000 with another provider. The reason I say that is if you start with a provider, it's trustworthy and regulated, its fees are very low. But then along the way, you want to invest in a particular stock or in a particular ETF and you find out that they don't have it on their platform, you can find another provider that also meets those first two criteria, but also has the particular asset you want to invest in. Open an ISA with them and invest in the assets with them. So that's one way to handle it, but I generally prefer to keep all my assets in one place. So if we apply all those rules, my two favorite options as of today, things may change in future, but for now, I'll leave the links in the description. But the two stocks and shares ISA providers that I use right now, Trading 212 and InvestEngine. Trading 212 allows you to invest in both individual stocks and ETFs. InvestEngine only allows you to invest in ETFs. But when you're picking certain individual stocks on Trading 212, if the stock is domiciled in the US and it's domiciled in dollars, for instance, then they charge a fee for the currency conversion. Basically, that's the only thing they charge you for. But if you keep all your investments in pounds, then you will never run into that issue with Trading 212, and you can invest purely for free with them. The other company is InvestEngine. I have to put a disclaimer here. I have investments in the company InvestEngine itself because I bought some shares when they did a private placement a while back. But whether I had shares with them or not, I would use this platform. I use them as my primary ISA manager. What I like about them is the simplicity of the platform. InvestEngine gives you the vibe that you're just managing a normal, simple savings account. It doesn't give you that vibe of this is an investment platform. Although you have all the same information that you find on both platforms. It's just the way the user interface looks. They have a wide array of ETFs. Unlike Vanguard that only has Vanguard ETFs, they have both Vanguard and non-Vanguard ETFs on their platform. They have BlackRock ETFs. The only thing you can buy on their platform is individual stocks. Another thing I like about InvestEngine, so on Trading 212, when you want to buy something, say I want to buy X units of this stock, and then they calculate how much it's going to cost you based off the price. With InvestEngine, it's slightly flipped. With InvestEngine, you tell them this is how much money I have that I want to invest, which is how most people think about it. They don't think about it like, oh, I've looked at my budget for the month and now I want to buy 3 units of Google. No, they think about it like, I've looked at my budget for the month. This is how much money I want to invest this month. What can I invest with it? So what InvestEngine does for you is you open a stocks and shares ISA account, deposit money regularly, and then that money is split across whatever ETFs you put in there. So you could either go 100% globally diversified one single ETF, or split it between two. Say, oh, I want to put some a globally diversified ETF, but I want to have a bit of money on bonds and cash-like investments, not just 100% stocks. Then let's say you have, say, 80% globally diversified ETF, 10% bonds, 10% gold. Set up your portfolio like that within InvestEngine. Every time you put money in there, you can automate it such that it automatically spreads that cash across those percentages. So if you only have £300 this month to invest, you put in £300 there, it will automatically put 80% of that into your ETF for global stocks, 10% into gold, 10% into bonds, and that's it. You don't need to worry about how many units of gold can I buy or how many units of S&P 500 can I buy. It will also reduce the temptation to be selecting stocks every time you want to invest, because you just build your portfolio, set it up, and throw it in there. To be fair to Trading 212, it also has a similar feature called pies, where you can set up a pie chart and allocate percentages and now fund that pie. If you use any of the links that I share for these platforms, for either Trading 212 or InvestEngine, there's a high chance that it's an affiliate link. They don't always run their affiliate programs, but if the program is running and you use those links, I may earn something, but it doesn't affect you in any way. They are not charging you anything for it. You may actually also earn something depending on if they are still running the program. But that's not what this is about. You can always just type InvestEngine into Google and go directly to the website. Like I said before, if you want, you can use the two of them, so long as your total for the year doesn't exceed £20,000 allowance. You're fine to open multiple ISAs of the same type, but the cap is still £20,000 across all your ISAs. So let me share my screen. So here, let's say we don't have an account yet. Get started. You're an individual, not a business. You put in your email. Let me just call it my e-test. It's whatever my email is. So you see the criteria is you must be 18 plus, you must be UK resident, you must be UK tax resident, meaning you pay taxes in the UK for you to open an ISA account. If you just want to invest with them and you pay taxes in, say, a different country, fine. But if you want an ISA account, then you must be paying your taxes here. You see, brand new account. It's just, you can start by creating a new general investment. I don't want a general investment portfolio. Well, let's see what it says. Or you can put cash, or you can do an ISA or a SIP. So a SIP is a pension account, personal pension. Now, finish registration, verify your email address, and so on. I will verify my email address quickly. Let's come back here. I don't want to put in too many details, but you have to verify your address, put in your phone number, put in your contact details, basically open the account. Let's assume I want to buy something now. So once you verified your email address and details, you can add cash, right? You can open an ISA. Let's open an ISA. Ask me a bunch of questions. So it gives me the option, do I want to do it myself or do I want them to manage it for me? I'll do it myself because it's pretty straightforward to do. They're asking you which investments you want to invest in. Let's just pick this for now. Alright, so we pick the Invesco FTSE All World and just add it to the portfolio, right? So now we have a portfolio, we can continue. And it says your chosen weight will apply to future investments. So if I want to keep it 100%, FTSE All World is fine. If I want to update to add others, then it's okay. You can always add others or leave it like that. One thing I like about it is it tells me how that ETF, how that investment is split. Because if I have multiple ETFs, these percentages will change. But for now, we just picked one single ETF with 100%, but it's a global ETF. So 59.5% of that ETF is North American companies. 11.5% is companies in Europe, excluding the UK. You have the UK separate alone as 3.5%, usually it's around 4%, and EU around 11%, North America around 60%, and then Asia, excluding Japan, is about 6%, Japan alone is about just under 6%, and then you have emerging markets at about 5%. Emerging markets basically covers China, Russia, India, South Africa, and Brazil. You can actually click to see what any of these means. This is basically North America, US, and a little bit of Canada, mostly US. Asia ex Japan, you have Asian countries excluding Japan, China, and India, because you already have China and India in emerging markets. And then of course UK is UK, and the rest of the world is anywhere that is not covered in the above list, where you have all these classifications. Now the other thing you can see here is the sectors that they are split across. So you have industrials, which are regular manufacturing companies. You have tech companies. You have your financial companies, your big banks. You have consumer goods, which is a little smaller. Disney, Coca-Cola, and the rest are in here. And then healthcare and so on. But you can actually check the biggest companies in this mix. So you see the biggest companies are all tech companies. So you have your Nvidia, you have Apple, Microsoft, Amazon, and so on. These are the biggest companies in this global ETF. And then you can save and continue. Now it says you're ready to start investing. You've chosen your ISA, you've chosen your ETF, and you've set your portfolio weight, which is 100% global. Now you can just add cash and place your first order, or you can make it automated. Again, I always prefer to keep things automated. So you see it says the portfolio TER, which is the cost of the portfolio. So this is charged by the ETF provider, which is Invesco. So they are charging 0.1% of whatever you invest. Again, InvestEngine is free, so they are not charging that. And then you can set up your cash. So here, cash, you can add cash. I have to finish my registration to be able to add cash to tell them who I am before they collect money from me. You can also set up a savings plan. So every week or every month or every 2 weeks, you automatically deposit money. So let's say monthly, I want to be putting in £500 and I continue. So let's say monthly, it asks me when I want to put it in. Let's say I pay it in the middle of the month after I've sorted out other things. Or I want to pay it on the first of the month. Immediately I get my salary. And then how much you pay, let's say £500 every month. And then you continue, and then it's set up. I just need to finish registration. And then the other thing is auto invest available cash. You can just switch that one on. What that does is, let's say you have some investment that pays you dividends or returns within their account. InvestEngine will automatically reinvest it according to your percentages. So you can activate that. That one doesn't require cash. You can actually tell it to keep some cash. So it will invest everything above this amount. For instance, it's saying if you set a cash profile of £25 and you have a total of 100, then it will invest 75. In this case, I'm putting my cash profile at £100. So once the money passes £100, it will automatically invest everything above it, which I think is a neat feature. So let me see, what else do I want to do here? You can always edit your portfolio if you want. You can check portfolio analytics, which basically brings you this whole page again and shows you your breakdown, your asset class. So by the time you add other things like bonds, cash, and so on, it shows you what your portfolio is like. You can also find that at the top here. It's the same thing. It takes you to the same page. You can check your transactions. You can check your reports if you need to generate a report for tax purposes. If it's an ISA, you won't need that. But if you have a general investment account, which you can also have, then you would need those reports. So that's it. So if you have any questions, please leave them in the comments below. Tomorrow we'll talk more about selecting the right investments. See you then.